Okay, let's unpack this. We tend to look at the stock market like it's this giant, chaotic casino.
Mm.
You see the ticker scrolling on CNBC, green numbers, red numbers, people shouting on the floor of the NYSE, and it feels like this mysterious black box where money just, well, it appears and disappears based on luck or magic.
It really does feel that way, but it's not.
But if you actually stop and peel back the layers,
Yeah.
really look at the plumbing, it isn't a casino at all. It is an incredibly intricate man-made machine.
It is. It's a machine with very specific mechanics, very specific gears grinding against each other, and a rule book that is, it's thick enough to stop a bullet.
Exactly. And for this deep dive, we are doing something a little different. We are taking a massive stack of sources, essentially a mountain of exam-level practice questions, regulatory frameworks, and explanations.
All the dry stuff.
All the dry stuff. And we are going to decode the securities universe.
Which sounds daunting, but it's actually, I think, the best way to learn. We aren't just going to read off questions and answers. That would be incredibly boring.
Oh, awful.
We'd lose everyone in 5 minutes.
Terrible. No, the mission here is fluency. We're going to take those dry facts, the stuff you'd see if you were prepping for a Series 7 or an SIE exam, and we're going to turn them into a living map of the financial system.
Right.
We want to understand the language of Wall Street so that when you hear these terms in the wild, you aren't just nodding along, you actually know the mechanics.
Right. And whether you're actually studying for one of those licenses or you just want to know what your financial advisor is actually saying when they talk about hedging with puts or yield curves, this is the shortcut.
We're going to cover everything from how firms legally print money as market makers to how you can bet against a currency.
And perhaps most importantly, why that safe bond you bought might actually be a risky bet if interest rates move the wrong way. It's about that hidden risk.
It's about moving from being a passive observer to really understanding the game board. So let's jump right in. Section 1, the cast of characters.
The players.
Because before we talk about what is being traded, we need to talk about who is doing the trading. And there is this fundamental dual identity in the financial world that kept popping up in the sources.
The broker versus the dealer.
To the average person, those words are synonyms. I called my broker. I called my dealer. Well, maybe not dealer in that context.
Really not that context.
But in finance, these are two totally different legal hats, right?
They have completely different legal capacities. And the sources use a really helpful distinction here. Think of it this way. A financial firm like a Morgan Stanley or a Goldman Sachs can wear two hats.
Okay.
But they can't wear them both at the exact same time for the same trade. They have to pick one.
Okay, let's start with the broker hat. When a firm is acting as a broker, what is their actual role? What are they doing?
When a firm acts as a broker, they are acting as an agent. That's the key word. They are a matchmaker.
A matchmaker.
Think of a real estate agent. If you hire a real estate agent to sell your house, they don't buy your house from you.
Right, no.
They go out and find someone else to buy your house. They're the middleman.
So they are just the conduit. They connect buyer and seller.
Exactly. You want to buy 100 shares of Apple stock. Someone else in the world wants to sell 100 shares of Apple stock. The firm, acting as a broker, connects you two. They don't own the stock. They just facilitate the introduction. They have no skin in the game.
Okay, so no risk for them. And how do they get paid for that matchmaking service?
A commission. That's the key metric. If you see the word commission on your trade confirmation slip, that tells you your firm acted as a broker. They took no risk. They just introduced you and took a small fee for their trouble.
The source material had a really catchy memory aid for this. ABC.
I love this one. It's classic test prep gold. It just sticks in your brain. ABC.
So what does it stand for?
Agency, broker, commission.
Agency, broker, commission.
If you can remember ADC, you know exactly what a broker does. They are the agent and they charge a commission.
Simple enough. Now let's swap the hat. The same firm, maybe on the very next trade, is now acting as a dealer. How does the dynamic change?
Completely. When they act as a dealer, they are a principal. Now let's switch the analogy from a real estate agent to a used car lot.
Okay.
When you go to a used car dealer, they own the cars on the lot. They bought them. They are sitting in their inventory.
So if I want to buy a car, I'm buying it directly from them. They're the other party in the transaction.
Correct. They aren't finding a seller for you. They are the seller. Or if you're selling your car to them, they are the buyer. They are trading from their own inventory using their own capital.
That sounds significantly riskier for the firm.
It is much, much riskier. Because if they buy your stock into their inventory, just like if a dealer buys your used car and then the market for that stock crashes 5 minutes later, they are stuck with it.
They're holding the bag.
They are holding the bag. They assume the risk of the securities price fluctuating while they hold it.
And since they are taking a risk, I assume they aren't doing it for a flat commission. The compensation must be different.
It is. The compensation is for the risk. When they act as a dealer or principal, they make money on the markup or the markdown.
Okay, break that down.
If they sell a security to you from their inventory, they charge a markup. They sell it for more than they paid for it.
Like the used car dealer.
Exactly. And if they buy a security from you into their inventory, they charge a markdown. They're buying it from you at a slight discount to what they think it's worth.
So a firm is called a broker-dealer because they have the license to do both of these things.
Precisely. They can switch hats depending on the trade, the security, the market conditions. But, and this is a huge regulatory point that shows up on every exam in any single transaction, they must pick one capacity.
Just one.
Just one. You cannot charge a commission and a markup on the same trade. That's double dipping, and it's a major violation.
You can't charge me a fee for finding a buyer if you are the buyer.
That makes no sense. The regulators would come down on you like a ton of bricks for that. You have to disclose your capacity on the trade confirmation.
That makes perfect sense. Okay, so that's the firms. Now let's talk about the investors.
Yeah.
Because I think people assume an investor is an investor, but the SEC treats people very, very differently depending on how deep their pockets are. We have the big money players.
We do. And the whole philosophy behind this is investor protection. The SEC's job is to protect the little guy, but they basically assume that if you have enough money, you're a big boy or girl, and you don't need as much protection.
You can afford sophisticated advice, or you're sophisticated yourself.
Right. So the definitions get very specific here. First, at the top of the pyramid, you have institutional investors.
It sounds like the banks, the insurance companies.
It is. It's the big entities: banks, insurance companies, investment companies, pension funds. But the sources clarify that an institutional account can also be any person or entity with total assets of at least $50 million.
50 million. Wow. Okay, that's a high bar. That's the ultra wealthy.
That's the 1/10 of 1%.
But then there's a term I hear thrown around a lot more often, especially in like tech and real estate circles, accredited investor. This is the ticket you need to get into the private deals, right?
Right. This is the gatekeeper designation. If you want to invest in a hedge fund or a private placement or a pre-IPO startup, you usually need to be accredited. The SEC says these investments are risky, they're illiquid, they're not registered with us, so we only want people who can afford to lose their money to play in this sandbox.
A financial shock absorber, essentially. You have to be able to take the hit.
You have to be able to take a total loss and not have it affect your lifestyle.
So what are the magic numbers? How do you qualify?
There are two main paths. The first is the net worth test. For an individual, you need a net worth of $1 million.
$1 million.
But, and this is a big but, that catches people out. That excludes the value of your primary residence.
Oh, that's huge. So I can't just live in a really expensive house in Palo Alto and claim I'm accredited if I have no cash.
Exactly. The SEC changed that rule after the 2008 housing crisis. They realized people were house rich and cash poor. You can't pay your bills with your kitchen. They want to know you have a liquid financial stability outside of the roof over your head.
Got it. So liquid-ish net worth of $1 million? Or is there an income route?
There is. The income test. You need an annual income of $200,000 as an individual or $300,000 if you file jointly with a spouse.
And is that just for 1 year?
No, you need to have met that threshold for the last 2 years, and this is key. You need to have a reasonable expectation of making it again in the current year. They want to see a stable, high income.
Now, I saw something really interesting in the sources. It used to be just about the money.
What?
But recently, you can also kind of buy your way into this club with your brain, not just your wallet.
Yes. This is a great and relatively new change. The SEC recognized that financial sophistication isn't just about wealth, so now holding certain professional licenses automatically qualifies you.
Which ones?
If you hold a Series 7, which is the general securities license, a Series 65, the investment advisor license, or a Series 82 for private placements, you are considered an accredited investor.
Even if you don't hit the income or net worth requirements.
Even if you're fresh out of college and broke, The license itself is your proof of sophistication.
Which makes sense.
Hmm.
If you are licensed to sell these complex products to other people, you probably understand the risks enough to buy them yourself.
That's the logic. But oddly, and the source material specifically calls this out, the Series 79, which is the investment banking license, is not on that list.
Wait, really? The investment bankers are left out.
It's a strange quirk, so if you're a junior investment banker, check your bank account, because your license won't get you into those deals.
Okay, so we have institutional investors, we have accredited investors, then there is the boss level, the QIBs.
The qualified institutional buyers, these are the heavy hitters, the absolute titans of the financial world.
What's the threshold for that?
To be a QIB, you must own and invest on a discretionary basis at least $100 million in securities.
$100 million. That is a staggering amount of money.
It is. And here's the kicker, the key distinction. Humans cannot be QIBs.
Wait, what do you mean?
You, as an individual person, can be an accredited investor. But QIB status is reserved for entities only.
So even if I win the Powerball and have $500 million in my personal brokerage account, I'm not a QIB.
Nope. You're just a very rich accredited investor. A QID has to be an entity, an insurance company, a pension fund, a bank, a mutual fund company. It's a totally different tier of regulation, mainly for trading large blocks of unregistered securities among themselves.
All right, that's a clear breakdown of the players. Let's move to Section 2, the asset classes. We know who is trading. Now, what are they trading? Let's start with equity stocks, the ownership stake.
The piece of the pie, the most common thing people think of when they hear investing.
There is a distinction in the notes about authorized versus issued stock. It sounds like boring legal jargon, but why does a regular investor need to care about this?
It matters because of dilution. It's actually a really important concept.
Okay.
Think of the corporate charter as the birth certificate of the company. When the company is formed, it states in the charter the maximum number of shares it is allowed to sell. That's the authorized stock.
So it's the legal ceiling. Let's say it's 10 million shares.
Exactly. Then issued stock is what they have actually sold to the public to raise capital. Let's say they've issued 5 million shares.
So they have another 5 million shares sitting in the reserves, authorized but not issued.
Right. They're sitting in the corporate treasury. And if you own stock, you need to know that the board of directors has the power to sell those other 5 million shares whenever they want, for example, to raise money for a new factory.
And if they do that, my slice of the pie gets smaller.
Precisely. That's dilution. Your ownership percentage goes down. That's the authorized versus issued dynamic.
Yeah. And what about treasury stock? Where does that fit in?
So treasury stock is stock that was issued, but then the company bought it back from the open market.
Why would they do that?
A few reasons. Maybe they think their stock is undervalued, so it's a good investment. Or they want to reduce the number of shares outstanding to boost the earnings per share.
So that stock just sits there.
It sits in the company's treasury. It's important to know it doesn't have voting rights and it doesn't receive dividends. It's basically in suspended animation.
And that leads to the last term, outstanding stock.
Right. Outstanding stock is what really matters to the market. It's the issued stock minus the treasury stock. These are the shares that are actually in the hands of investors that trade every day, that vote, and then get dividends.
Okay, let's pivot to a specific type of stock that confuses a lot of people. Preferred stock. It's like a hybrid. It's stock that thinks it's a bond.
That's a great way to put it. It has features of both. It pays a fixed dividend, like a bond pays interest. It has a par value, like a bond. It usually doesn't have voting rights, but it's technically equity.
So it's lower on the priority list than bonds if the company goes bankrupt.
Correct. Bondholders get paid first, then preferred stockholders, and then if there's anything left, common stockholders get the scraps.
The big takeaway from the sources was the difference between cumulative and non-cumulative preferred stock.
This is a huge feature. It's a deal breaker for many preferred stock investors.
Walk me through that scenario.
Let's say a company runs into trouble, maybe a recession hits, and they have to suspend their dividend payments to save cash. They can't pay anyone this year.
Okay.
If you hold cumulative preferred stock, the company still owes you that money. The missed dividends accumulate in what's called arrears.
It's like an IOU.
It's an IOU.
Yeah.
And they cannot pay a single dime to the common stockholders, the regular investors, until they have paid you, the cumulative preferred holder, back for everything they missed.
That's a massive safety net, a huge protection.
It is. But if you hold non-cumulative preferred and they miss a payment,
Let me guess. Tough luck.
Tough luck. It's gone. You lose out on that missed payment forever. There's no IOU.
I can see why the cumulative is, well, preferred,
Points.
intended.
Yeah.
Now, what about convertible preferred?
This is for the investor who wants the best of both worlds. They want the safety of the fixed dividend, but they also want to dream a little.
They have FOMO, fear of missing out on a rally.
Exactly. Convertible preferred is preferred stock that you can, at your option, swap for a fixed number of common shares.
So if the company's a startup and it suddenly takes off and the common stock price skyrockets,
You can convert your safe, boring preferred shares into the high-flying common shares and ride the wave up. You give up your dividend for that potential upside.
the math on that involved a conversion ratio. How's that work?
Right. The terms are set when the stock is issued. It's usually the par value, typically $100 for preferred stock divided by the conversion price. So if the par value is $100 and the conversion price is stated as $20, your ratio is 5.
Meaning I get 5 shares of common for every 1 share of preferred you turn in.
Precisely. You're always looking to see if the market value of those 5 common shares is greater than the value of your preferred share.
Okay, let's flip the coin to debt. Bonds.
The IOUs of the corporate and government world.
The biggest concept here, the one that I swear trips everyone up, is the teeter-totter.
The teeter-totter. This is the golden rule of bonds. It is non-negotiable. If you remember nothing else from this section, remember this. Bond prices and interest rates have an inverse relationship.
Inverse. When one goes up, the other goes down.
Always, without fail.
Let's really drill into the why here, because people hear it, but the intuition isn't always there. Why does the price go down when rates go up?
Let's make it concrete. Imagine you buy a brand new 10-year Treasury bond today for $1,000. That's its par value. And it pays you 3% interest. That's its coupon rate.
So $30 a year.
$30 a year every year for 10 years. You are happy, it's safe. But tomorrow, the economy heats up and the Fed raises interest rates. And now, new bonds are being issued, same risk, same company or government, that are paying 5%.
Okay, so now I'm sitting here holding a piece of paper paying 3% when everyone else can go out and buy a new one that pays 5%.
Exactly. Nobody wants your 3% bond at face value anymore. It's inferior. It's obsolete. So if you want to sell it on the open market, you can't get $1,000 for it.
Nobody would pay that.
They'd be crazy to. You have to put it on sale. You have to lower the price, maybe to $950, maybe $900. You have to lower it to the point where the yield, the return on that lower price, becomes competitive with the new 5% rate.
So rates went up and your bond's price went down.
Mechanical. It's a mathematical certainty. And the reverse is also true. If rates fall to 1%, your 3% bond is suddenly a gold mine. Everyone wants it. You can sell it for more than you paid.
For a premium.
For a premium. That's the teeter-totter.
That leads us perfectly into yields.
Yeah.
Because the sources listed 3 different ways to measure how much money a bond makes, and they tell very different stories.
Yes, and this is where a lot of the marketing confusion comes in. First, the simplest one is the nominal yield.
Nominal.
That's just the coupon rate. It's printed on the face of the bond certificate. It never, ever changes. If it says 5%, it's 5% of the par value forever.
Simple. The fixed rate.
Then the current yield. This one changes every single day, every minute the market is open.
Because it's based on the market price.
Exactly. The formula is the annual interest, that fixed dollar amount, divided by the current market price. So in our previous example, if the price of the bond drops, the current yield goes up.
Because I'm paying less to get that same $30 check, my return on investment is higher.
Exactly. And then the third one, which is maybe the most important for your real life and also the most depressing, the real interest rate.
The can I afford burger next year rate.
That's it. This is the return you get minus the inflation rate. If your bond pays a nominal yield of 5%, but inflation is running at 4%, your real interest rate is only 1%.
You are barely treading water. Your purchasing power is almost flat.
And if inflation is 6%, your real return is negative. You are losing purchasing power even though you're getting paid interest.
The sources also quickly mentioned discount versus premium bonds regarding these yield relationships.
Right. It's just a quick check on your understanding. If a bond is trading at a discount, meaning its price is below its par value, its current yield will be higher than its nominal yield.
Makes sense. Lower price, higher yield.
And if it's trading at a premium prices above par, the current yield is lower than the nominal yield. It's just the teeter-totter in action again.
Okay, let's run through the major types of debt. We have treasuries, munis, and corporates.
Treasuries are the gold standard for safety. They are backed by the full faith and credit of the U.S. government. They have no credit risk, no default risk.
And the tax treatment is special.
Very special. T-notes and T-bonds are taxed by the federal government, but, and this is a nice perk, they're exempt from state and local taxes.
So if you live in a high-tax state like New York or California, treasuries look even better on an after-tax basis.
It's a significant advantage, and municipal bonds are the opposite tax-wise. They're issued by states, cities, school districts.
And their interest is?
Generally exempt from federal tax and often exempt from state and local tax, too, if you live in the state that issued the bond. A triple tax-free bond is the holy grail for high-income earners.
But you have to watch out for the type of muni because the risk is not zero.
Absolutely not. Not all munis are safe. You have two main flavors. First are general obligation, go-go bonds. These are backed by the full faith, credit, and taxing power of the issuer. They need voter approval because the town is literally promising to raise property taxes if needed to pay you back. These are generally very safe.
And the other kind.
Revenue bonds. These are backed by the revenue from a specific project, like a toll road, an airport, a hospital, or a sports stadium.
So if the project fails?
If nobody drives on the toll road or the stadium is a flop, the bondholders don't get paid. That's why they don't need voter approval. But they do need a feasibility study to show the project can generate enough cash. Much riskier.
That makes sense. And then there's this hybrid, this interesting one, the double-barreled bond.
The best of both worlds. It's primarily a revenue bond, backed by project revenue, but it's also backed by the taxing power of the municipality. It has 2 barrels of security firing for you, so if the project revenue falls short, the city steps in with tax dollars. Much safer.
Okay, Section 3. The toolkit. We're getting into options and derivatives. This is where people's eyes usually glaze over, but the sources break it down into very practical scenarios.
And that's the only way to understand them. Options are just contracts. They're tools. A call is a contract that gives you the right to buy a stock at a certain price.
The right to buy. And a put.
A put is the right to sell a stock at a certain price.
And the standard contract size is key.
It is. One options contract always represents 100 shares of the underlying stock. Always multiply by 100.
Yeah.
If the premium is quoted at $2, the contract will cost you $200.
Let's talk strategies, specifically hedging. The outline gave us an exporter scenario and an importer scenario. I love these because they show why businesses use options. It's not just Wall Street speculation, it's like corporate survival.
Right. It's risk management 101. Let's take the exporter. You are a U.S. company making, I don't know, high-tech widgets. You sell a massive shipment to a customer in Japan.
Okay.
You are going to get paid in Japanese yen in 30 days. Let's say it's 100 million yen.
So my risk isn't about my widgets. I made a good product. My risk is the currency exchange rate.
Correct. You are long the yen because you are owed yen. Your number one fear is that the yen drops in value against the dollar before you get paid. If the yen crashes, your profitable widget sale just became a huge loss.
So how do I hedge that fear? How do I protect myself?
You buy yen puts. A put gives you the right to sell the yen at a fixed price, a fixed exchange rate.
So it's like an insurance policy.
It's exactly like an insurance policy. If the yen crashes in the open market, your put option goes way up in value, and that profit offsets the loss you took on the currency itself. You've locked in a floor price.
Okay, so that makes perfect sense. Now let's flip it, the importer. I'm a U.S. business buying fancy cheese from Europe. I have to pay my supplier in euros in 60 days.
Your risk here is the exact opposite. You are short the euro, you have to spend euros. Your fear is that the euro rises against the dollar.
Right. If the euro gets really expensive, my cheese gets expensive, and my entire profit margin vanishes.
And you might even lose money on the deal. So you hedge by
buying euro calls.
Exactly. A call gives you the right to buy euros at a fixed price. If the euro skyrockets, your call option lets you buy them cheap, protecting you from that price spike. You've locked in a ceiling on your costs.
That makes it so much clearer than just memorizing exporter buys puts, importer buys calls. It's about what you're afraid of.
It's always about hedging your fear. If you fear the price going down, you buy a put. If you fear the price going up, you buy a call.
Now, what about for the average investor who just wants a little extra income from their stock portfolio, the covered call?
This is hands down the most common and most conservative option strategy.
Yes.
Let's say you already own 100 shares of Apple stock. That's the covered part. You own the underlying stock. You then write, which means sell, a call option against it.
But you get paid for that.
Instantly. You collect the premium money up front. It goes right into your account. It's like renting out your stock to someone else for a month. You're generating income from an asset you already own.
But you limit your upside. Right.
Yeah.
That's the trade-off.
That is the entire trade-off. If Apple stock goes to the moon, way past your strike price, you are obligated to sell your shares at that lower strike price. You miss out on the huge rally.
So it's a good strategy if you think the stock will stay flat or go down a little bit.
Or go up just a little. You keep the stock and you keep the premium you collected. It boosts your portfolio's return.
Let's do a quick math check. Break Vendons. How do you figure out where you start making money?
Super simple formulas, but you have to follow the cash. For any option you buy, the premium you pay is a cost. You have to overcome that cost to break even.
Okay.
For a put, you make money when the stock goes down. So the stock needs to drop below the strike price enough to cover your premium. Break-even is strike price minus the premium.
And for a call?
For a call, you make money when the stock goes up. Break-even is strike price plus the premium. You have to climb over that hurdle.
And what about intrinsic value? I hear that term a lot.
Intrinsic value is the real value. It's how much the option is in the money. It can't be negative. It's either zero or positive.
So give me an example.
If you have a call option with a strike price of $40 and the stock is currently trading at $43, you have $3 of intrinsic value. You have the right to buy something for $40 that's worth $43.
But the option might be trading for $4.
Right, and that extra dollar, that's the time value. It's the speculative value, the hope that the stock will go even higher before the option expires.
Speaking of expiration, what are the rules there?
For standard equity options, they expire on the third Friday of the expiration month. Trading in that option stops at 4:00 p.m. Eastern Time, but you actually have until 5:3 p.m. ET to tell your broker you want to exercise it.
Good to know. Okay, moving on to Section 4, packaged products. This is where most people live. Mutual funds.
Specifically, open-end funds. These are what most people have in their 401ks and IRAs.
What's the open end mean?
It means they are a continuous offering. They create new shares whenever someone wants to invest and redeem shares when someone wants to sell. The fund gets bigger or smaller every day.
And they are priced once a day, at the end of the day.
Right. They're priced once a day at the close, at the net asset value, NAV. You just take the total value of all the stocks in the portfolio, subtract any liabilities, and divide by the number of shares. That's the price you get.
But the fees. Well, the fees. The sources listed a few nasty ones that can really eat into your returns.
This is where you have to read the fine print. The first one is the 12B1 fee.
What in the world is that?
It's a fee for marketing and distribution. Basically, you, as a current shareholder, are paying the fund to advertise itself to attract new shareholders.
Wait, I'm paying for their commercials.
You're paying for their commercials, for their brochures, for commissions to the brokers who sell the fund, and even no-load funds with no upfront sales charge can charge this.
What's the limit on that for a no-load fund?
A fund can only call itself no-load if its 12B1 fee is beta 0.25% or less per year. It's a small but constant drag on your performance.
Then there is the expense ratio, which is the big one.
That's the big one. The expense ratio covers the day-to-day operating costs. The biggest piece of it is the management fee paid to the portfolio manager, but it also includes administrative costs, legal fees, etc. It's the ongoing price of admission.
What about breakpoints? This sounds like a good thing. It's like a bulk discount on sales charges.
Right, exactly. For funds that have a front-end sales charge or load, the percentage you pay goes down the more you invest.
So if I invest $5,000, I might pay a 5% sales charge, but if I invest $50,000, it might drop to 4%.
Right. The fund company gives you a breakpoint discount for investing a large amount.
And the sources mentioned you don't even have to have all the money at once to get the discount.
Correct. There are two ways to do this. First is rights of accumulation. This allows you to combine the value of your previous investments in the same fund family, including any growth, with a new purchase to qualify for a breakpoint.
So my old money helps my new money get a better deal.
Exactly. And the second way is a letter of intent, LOI. This is a non-binding document where you promise the fund company that you intend to invest enough money to reach a certain breakpoint over the next 13 months.
It's like putting the fee on a layaway plan.
It is. They give you the lower sales charge right away on all your purchases. But if you don't hit the target after 13 months, they go back and charge you the higher fee you would have owed. They usually hold some of your initial shares in escrow, just in case.
Fair enough. Now, let's contrast these open-end mutual funds with closed-end funds.
Closed-end funds are a totally different animal. They have an IPO, just like a stock. They issue a fixed number of shares to raise capital, and then the door closes.
So no new shares are created?
None. After the IPO, those shares trade on an exchange, like the New York Stock Exchange, all day long, just like a stock.
And because they trade on an exchange, their price is set by
Supply and demand, not just the value of the assets inside. So a closed-end fund can trade at a premium to its NAV if it's really popular, or, more commonly, at a discount to its NAV if it falls out of favor. A mutual fund always trades exactly at its NAV.
That's a key difference. Now, REITs, real estate investment trusts.
Yep.
The sources highlighted a magic number here, 90%.
The 90% rule. This is the defining feature of a REIT. To avoid paying corporate income tax, which is a huge structural advantage, a REIT is required by law to distribute at least 90% of its net taxable income to its shareholders in the form of dividends.
This makes them absolute yield monsters for income investors.
It does. They are designed as pass-through entities. They just collect the rent or interest and pass it straight through to you.
And there are two main types.
Yep. Equity REITs are the most common. They actually own property, office buildings, apartments, shopping malls, and their income comes from rent. Mortgage REITs don't own property. They lend money to property owners. They own the mortgages, and their income is the interest they collect.
Finally, in this section, annuities, specifically variable annuities. These could be complicated.
They are. They're basically an investment portfolio wrapped inside an insurance policy. They're sold by insurance companies as a retirement vehicle.
And the money goes into a special account.
Yes, the terminology is important. Your investment in a variable annuity goes into a separate account. It's kept separate from the insurance company's general funds. You, the investor, choose the sub-accounts, which are like mutual funds, and you take all the investment risk.
But it grows tax deferred.
That's the main selling point. It grows tax deferred, like a 401k, but there's also an insurance component, a safety net.
The death benefit.
Right. If you die during the accumulation phase before you start taking payments, your beneficiary is guaranteed to get back at least what you put in. They get the greater of the amount you invested or the current market value.
So if the market crashes and you die, your heirs at least get your principal back.
Exactly. It's protection against dying at the worst possible market moment. And that insurance wrapper costs money, which is why the fees on annuities are often higher than on mutual funds.
And what about the payouts? There was a specific one mentioned, life with period certain.
This is one of many payout options. Life with period certain means the insurance company will pay you for your entire life. But if you die early, say after only 3 years of a 10-year period certain, it guarantees payments will continue to your beneficiary for the rest of that 10-year period. It protects against an early death.
Section 5, mechanics of the trade. This is the nuts and bolts. When I hit the buy button on my app, what actually happens?
It all depends on the order type you used, the instruction you gave your broker.
Let's start with the most basic, the market order.
A market order says, I want it NW. Speed is the priority. You're telling your broker to execute the trade immediately at the best available price in the market right this second. You'll get your shares, but the price might slip a few cents or dollars if the market is moving fast.
You get the trade, but you don't get to name your price.
Exactly. A limit order is the opposite. It says price is the priority. With a limit order, you say, buy me 100 shares, but only at $50 or lower. If the stock is trading at $50.01, your order just sits there. You don't buy.
So you might not get the trade done at all.
You might miss it. It's a trade-off between certainty of execution and certainty of price.
And stop orders. These seem different. They aren't for getting into a position, but getting out.
Mostly. Think of a stop order as a trigger. It sits dormant, invisible to the market, until the stock price hits a certain level. Then it springs to life.
Okay, so let's take a sell stop. How does that work?
A sell stop is used to protect a profit or limit a loss on a long position. Say you own a stock at $100. You're nervous it might fall. You set a sell stop order at $90.
Okay.
The order does nothing as long as the stock is above $90. But if it drops and trades at or through $90, bam, your order is triggered and it instantly becomes a market order to sell.
It's an ejection seat. Get me out before it gets worse.
It's an automated ejection seat. And a buy stop is the opposite. It's used to protect a short position. If you shorted a stock at $50, you're afraid it will go up. So you place a buy stop at, say, $55 to get you out and stop your losses if you're wrong.
Speaking of short selling, this is a concept that feels unnatural to a lot of people. You are selling something you don't own.
It is unnatural, and it's bearish. You are betting the price will go down. What happens is you borrow the stock from your broker, they lend you shares from their inventory or from another client's margin account.
And then you sell it.
You immediately sell it in the open market and you pocket the cash, but now you have a debt. You have an IOU to your broker for those shares.
So your goal is to buy the shares back later at a lower price.
Right. You want to sell high, buy low. If you short at $50 and buy it back at $30, you make a $20 profit per share.
But the risk.
Yeah.
The sources were very clear on this.
The risk is unlimited. This is critical. If you buy a stock at $10, the absolute worst that can happen is it goes to zero. You lose $10 a share, that's your maximum loss.
It's defined.
It's defined. If you short a stock at $10 and it turns out to be the next big thing and it goes to $100, $500, $1,000, you still have to buy it back at that price to repay the loan. A stock can theoretically go up forever.
Which is why the regulation requires you to do this in a special type of account.
You cannot short sell in a cash account, period. It must be done in a margin account where you've pledged collateral and have the ability to borrow from the firm.
Let's touch on settlement. When do I actually own the thing, or when do I have to pay for it?
The world is getting faster. Standard settlement used to be T+3, then T+2 for a long time. Now T+1, or the next business day, is the standard for most securities.
So that includes stocks.
Stocks, ETFs, and notably, corporate bonds and municipal bonds have also moved to T+1, according to the latest updates. So if you trade on Monday, the cash and securities have to change hands on Tuesday.
What about options and treasuries?
They've always been faster. Treasuries settle T+1, and options also settle T+1. And then there's cash settlement, which is for same day. It's less common and usually costs more.
And the ex-dividend date. This always seems to confuse people.
This is a game of musical chairs for income investors. The ex-date is the first day the stock trades without the dividend attached to it. The company sets a record date, and the ex-date is set by the stock exchange as one business day before the record date.
So if I want to get that dividend check,
You must buy the stock before the ex-date.
mm-hmm.
Or, to put it another way, you must own the stock by the market close on the day before the ex-date. If you buy it on the ex-date or after, the dividend stays with the seller.
And the stock price actually adjusts for this, right?
It does. On the morning of the ex-dividend date, the stock price will typically open lower by roughly the amount of the dividend payment because that value is no longer attached to the stock.
Section 6. The rule book. This is where we get into the law and order part of the dive. Let's start with the big one. Insider trading.
Trading on material non-public information, or MNPI.
Break that down. What's material?
Material means it's information that a reasonable investor would consider important in making a decision to buy or sell. Think an upcoming merger, a surprising earnings report, a new drug getting FDA approval.
And non-public is obvious.
The general public doesn't know it yet.
Yeah.
If you are an insider, a director, an employee, or if you tipped off by an insider, you cannot trade on that information.
And the penalties are not a slap on the wrist.
They are severe, to put it mildly. The SEC can impose a civil penalty of up to 3 times the profit made or loss avoided. They call it treble damages.
So if you made an illegal profit of $100,000, they can fine you $300,000.
Yes. Plus, you have to give back the original $100,000 profit. And that's just the money part. The Department of Justice can come in for criminal charges, and you can face significant prison time.
There were some other specific forms of market manipulation listed in the sources. Let's run through them. Backing away.
That's a sin specific to market makers. A market maker is required to publish a firm two-sided quote, "I will buy at $10, I will sell at $10 or 5 cents. If you hit their bid and say, sold, you bought it at $10, and they say, actually, no, I'm not going to, that's backing away. It's a failure to honor their quote.
Marking the close.
This is placing a flurry of trades right at the end of the day at 3:59 p.m. with the intent of artificially influencing the closing price of a stock.
Why would someone do that?
Maybe a portfolio manager wants the stock to close higher so their quarterly performance looks better. Or maybe an option is about to expire and they want to push the stock price just above or below the strike price. It's highly illegal.
Interpositioning.
This is when a broker-dealer puts a third party between the firm and the customer unnecessarily, just to generate an extra fee or spread. It harms the customer by giving them a worse price than they would have gotten if the broker had gone directly to the market.
And front run.
This one feels the sleaziest. A firm receives a massive customer order, say a huge mutual fund, wants to buy 1 million shares of a stock. The trader knows that order is so big it will drive the price up.
Right.
So the trader, for the firm's own account, buys the stock first just seconds before executing the customer's large order. Then they ride the wave that their own customer created. It's a total breach of duty.
What about when things go wrong with the firm itself? It goes bankrupt. We mentioned SIPC earlier.
SIPC, the Securities Investor Protection Corporation. This protects you if your brokerage firm fails. It is not market insurance. If you buy bad stocks and they lose value, SIPC does nothing for you.
It's for fraud or bankruptcy of the broker.
Exactly. If your broker goes belly up and your securities are missing, SIPC steps in to make you whole.
What are the limits on that coverage?
The coverage is up to $500,000 total per customer, but only $250,000 of that can be for cash held in the account.
And this is totally different from the FDIC.
Totally different. FDIC, the Federal Deposit Insurance Corporation, protects bank deposits up to $250,000. SIPC is for brokerage accounts, FDIC is for bank accounts.
And let's cover anti-money laundering, AML. The government wants to track the flow of dirty money from illegal activities.
And they put the burden on financial institutions to be the gatekeepers. There are two main reports you need to know from the sources.
Okay.
First, the SAR, Suspicious Activity Report. This must be filed for any transaction of $5,000 or more that just smells fishy. There's no business sense to it, the client is being evasive, the money is moving to a known tax haven. It's subjective.
And the second one is objective.
Completely objective. The CTR, Currency Transaction Report, this is strictly math. Any cash transaction or series of cash transactions over $10,000 in a single business day triggers it automatically.
And what if I'm smart and I try to break my $12,000 deposit into 3 small deposits of $4,000 each to avoid that CTR?
That's called structuring, or sometimes smurfing. And it is a separate federal crime. You can go to jail for structuring even if the money was legally earned. Do not try to outsmart the bank tellers. Their software is designed to catch this instantly.
Section 7. The big picture. Economics. The 800-pound gorilla in the room, the Fed.
The Federal Reserve. The U.S. Central Bank. They control the money supply and interest rates. They have 3 main levers, but the biggest, most used one is open market operations.
This is them buying and selling government securities in the open market.
Right. Think of it like a faucet for the entire economy's plumbing.
Okay.
When the Fed buys Treasury securities from banks, they pay the banks cash for those securities. That injects money into the banking system. This is easy money. It lowers interest rates and stimulates the economy.
And when they want to fight inflation?
They do the opposite. The Fed sells securities to the banks, and the banks have to give the Fed cash. That takes money out of the system. This is tight money. It raises interest rates and slows the economy down.
And the other 2 tools, the rates.
The discount rate is the rate the Fed charges banks to borrow directly from them at the discount window. It's largely symbolic now, a signal of the Fed's intentions. The Fed funds rate is the big one.
That's the one you see on the news.
It is. It's the rate that banks charge each other for overnight loans to meet their reserve requirements. The Fed doesn't set it directly, but their open market operations push it towards their target. It's the most volatile interest rate in the world because it changes with every single interbank loan.
Finally, let's close out with economic indicators. How do we know where the economy is going?
Economists group them into 3 categories. Leading indicators try to predict the future of the economy. Things like the stock market itself, new building permits, and the money supply. They turn before the rest of the economy does.
And lagging.
Lagging indicators confirm what has already happened. They tell us where we've been. Things like corporate profits, the duration of unemployment, the prime rate. They turn after the economy turns.
And the dreaded R word. What is the technical definition of a recession?
The technical definition, the one most economists use, is a decline in the gross domestic product, or GDP, for 2 consecutive quarters. 6 straight months of the economy shrinking.
And how does that affect different types of stocks?
The business cycle has a huge impact. Cyclical stocks like automakers, airlines, heavy equipment manufacturers do really well when the economy is booming but get crushed in recession. Defensive stocks are the opposite.
Utilities, food, pharma.
Exactly. People still need electricity, toothpaste, and medicine, even in a recession. So these stocks tend to hold up much better when the economy tanks.
Wow. Okay, we have traversed the entire landscape, from the legal definition of a broker all the way to the nuances of Fed policy and the business cycle.
It's a lot of machinery, a lot of interconnected parts.
But synthesizing this knowledge,
Mm.
it seems like understanding these rules isn't just about passing a test or sounding smart. It's about spotting risks and opportunities in your own financial life.
Precisely. When you understand the teeter-totter, you understand interest rate risk in your bond portfolio. When you understand how to hedge with options, you can protect your business or your investments. When you understand the difference between a broker and a dealer, you know exactly who is sitting on the other side of the table from you.
It changes how you see everything. So here's a final provocative thought for you to chew on. The academics love to talk about the efficient market hypothesis, the idea that the market knows everything instantly and all prices are perfectly rational and correct.
Right. The theory that you can't beat the market.
So if the market is built on this perfect efficiency, why does this system require such immense complexity? Why do we need dark pools for anonymous trading? Why do we need stabilizing bids for IPOs? Why are there so many rules against manipulation?
It's a great question. If it's so efficient, it should be simple, but it's not.
So is the complexity a bug? Is it a sign that the market isn't efficient? Or is the complexity the product being sold?
The more complex the machine, the more you need a highly paid mechanic to help you navigate it.
And those mechanics charge very high fees. Something to think about.
It certainly is.
So next time you look at the financial news, look differently. Don't just see the ticker symbols. Spot the spread, spot the yield curve, and realize there is a market maker behind that headline pulling the levers.
Once you see the machine, you can't unsee it.
Thanks for diving in with us.
My pleasure. See you next time.